then we've got obviously some of the co-authors, Richard and Neil, on hand to try and answer them live, as it were, but without disturbing Andrew's flow, and then save the bigger questions for the Q&A at the end, where hopefully we'll have a good 35 minutes. I've asked Eric to do a slightly more formal response to kick off that Q&A. So over to you.
Thanks, Josh. Yeah, well, I'd like to say first, just thanks to Josh and Asker, and I guess UCL more generally for hosting us today. It's great to get an opportunity to share our research in this kind of forum, so it's much appreciated. Yeah, so Richard, Neil and myself have been working on trying to understand the intricacies of the UK government's banking arrangements and financial activities for several years now, and that's culminated in the paper that we wrote. The first version was released around Christmas, and the paper is essentially a walkthrough of various aspects of the government's financial activities, including spending, taxing, and securities trading. We present about 15 examples of distinct activities, both internal and external to the government, and track the specific transactions between the many parties involved using balance sheets. Now, this was a complex process for the reason that there are so many different institutions and entities involved. And as we see it, that there wasn't, at least previously, a synthesis of how these different entities interact with one another. Instead, much of the publicly available information is very, very disparate and doesn't obviously indicate kind of how the whole system fits together. And I guess the reason why this is potentially interesting, or certainly interesting to us, is that some of the conclusions that we've arrived at, I guess, are very different to what is usually purported in mainstream discourse. And hopefully that will be made clear as I go through. So I'll try to talk about a few of those, some of the components of our paper and the conclusions that were led to. And obviously myself, Neil and Richard are here for questions at the end. So I guess on the screen here, we have kind of a map, I guess, of some of the various institutions that are involved. There's a lot more detail that can be drilled into, but for now, there's, I guess, probably two things that I'd like to emphasize. One is that the Bank of England sits at the interface of the public sector and the private sector. Now, obviously, the bank is wholly owned by the government. It's unquestionably, objectively part of the public sector, but it's indicated spanning the public and private sectors here because it really represents the interface between the two in a financial sense. Secondly, the role of Parliament, I would suggest, needs to be emphasised. And I think we would probably say that it's commonly downplayed. Hopefully, as I get through the slides, I can demonstrate how important it is to the government's financial activities. Okay, so first I'll just give a quick description of the private sector and its banking arrangements, and I think that gives us a good foundation to look at how the government interacts with the private sector. Okay, so I think the first thing to consider here, and I should say I'm probably not telling anybody anything new here, I imagine, but hopefully it sets the scene nicely. The first thing to consider, I think, is that there are different forms of money used in the private sector, which I'm sure we all agree with. There are bank deposits that are issued by commercial banks, and these represent the main form of money that's used by individuals and businesses. But the central bank also issues money in the form of reserves and cash. And reserves are deposits held by commercial banks and which are used to settle transactions between banks. But we can also note that government securities represented in these balance sheets here as gilts are held by all of the different parties in the private sector. They're held by the central bank to back the central bank's money issuance and used in monetary policy operations, and therefore government securities are tightly coupled to what we think of as base money. And they're also held by commercial banks, and in that sense they're used as the medium of exchange for obtaining central bank reserves. So in that respect, government securities exhibit at least one of the crucial qualities of money, that they act as a medium of exchange. Government securities are also held by non-banks, though, and typically entities like pension funds, and And that's because they're the most secure alternative to other forms of money, for example, bank deposits. So in that sense, government securities also exhibit a store of wealth characteristic of money. So I think, yeah, I think what we'd argue is that all of those things represent forms of money used by the private sector. Okay, so let's just look quickly at a private sector payment example. So in the top left, we've got a person A that is transferring money to a person B. Now, the upshot of the transfer is that A's deposits are reduced and B's deposits are increased. We see that over on the top right. But we additionally see that A's bank, Lloyds in this case, loses central bank reserves, and the recipient's bank, HSBC, gains reserve deposits because they were sent over to settle the payment. So one bank's balance sheet reduces and the other increases. Now on the bottom, we've got a slightly different scenario. In this case, the paying bank has insufficient reserve deposits at the central bank to settle the payment. So in this case, the bank, Lloyds in this case, draws upon its stock of government securities to obtain the reserves needed. Now there's a few mechanisms within the UK system through which this could arise. One, for example, is collateralized intraday credit. But the upshot is that the securities have effectively paid to settle, being used to settle the payment. Okay, so we can now move into looking at how the UK government interacts with this system. So Parliament and what we can call the Exchequer are connected in two ways. They're connected via the Treasury, HM Treasury, which coordinates the spending and taxation processes within Parliament and also administers what are known as the central funds. The central funds serve to connect parliamentary legislation with the banking system. And I think two other components of the Exchequer are worth highlighting at this stage: Government Banking Service and the Debt Management Office. Now, I like to think of those as kind of the two interfaces with which the central funds interact with the banking system. Government Banking Service involves government expenditure and revenue, such as tax, whereas the Debt Management Office focuses on securities trading. So what I'll do is I'll discuss these items on the right here in that list, and I'll probably focus mostly on expenditure. And the reason for that is that some of the other processes, for example, borrowing, cash management, and tax, are usually framed in terms of expenditure. Borrowing and tax are usually described in such a way that they are providing for the government to be able to spend. But once we describe how government actually spends, that helps to reframe those processes. And so it makes sense to discuss expenditure predominantly and first, because then that helps to recontextualize some of the other things. Okay, so I'll just talk quickly about the central funds. So the central funds are kind of the legal and accounting structures where most of the action happens. They're where all of government expenditure arises from. They're where government securities are issued from, and they are the place that all taxation and other receipts head to. We've got the Consolidated Fund, which acts kind of like the government's current account, you could say. The National Loans Fund, which issues what we tend to think of as government debt, and also lends to public bodies such as local authorities. There's the Contingencies Fund, which is kind of like the emergencies fund, and the Exchange Equalisation Account, which deals with foreign exchange. I won't talk about that at all. I've also included the Debt Management Account here, though, which isn't technically one of the central funds, but it's kind of like a younger sister of the National Loans Fund, you might say, and it's useful to consider as one of the central funds, I think. The central funds have been described in a debate in the House of Lords. They've been compared to the Holy Trinity, and that they are jointly and severally incomprehensible. It is certainly true that they are complicated and mystifying to some extent. But I think the best way to understand them is kind of described on screen now, almost like a Russian doll. The reason for that is that, well, the National Loans Fund almost entirely funds the exchange equalisation account and the debt management account. And the Consolidated Fund funds the National Loans Fund and the Contingencies Fund. So really, the Consolidated Fund is the backstop on the entire system. And if you understand the Consolidated Fund, then I would argue you can understand the rest, which are essentially just kind of like sub-entities for organising the Consolidated Fund's accounts. Okay, so what exactly is the Consolidated Fund? Well, it was first set up in 1787 as a fund into which shall flow every stream of public revenue and from which shall come the supply for every service. It's governed by the Exchequer and Audit Departments Act 1866, which hopefully, as we'll see, is really quite fundamental to how the Exchequer operates. In 1968, the National Loans Fund was created, which kind of split the Consolidated Fund into two, and from that point, that was from which the Consolidated Fund became effectively the current account of the United Kingdom Exchequer. Yeah, I think it's worth saying right now that the Consolidated Fund and the National Loans Fund both hold accounts at the Bank of England, and they are both zeroed every night. And we'll see why and how that happens subsequently. But there's two other things to draw your attention to on screen here, and that is that the Consolidated Fund makes issues to finance supply services and standing services. So if we just look at the Exchequer and Audit Departments Act 1866, which governs the Consolidated Fund, we see that, well, firstly, there's a provision in there to ensure that all government revenue goes into the Consolidated Fund. Section 11 there, which is shown on screen there, states that nothing shall be issued out of the Consolidated Fund that is not authorised by Parliament, which is another really crucial clause in there. And then sections 13 and 15, they provide the mechanisms by which the payments can arise out of the Consolidated Fund for standing services and supply services. So standing services are services that are permanently authorised by Parliament, by specific acts of Parliament. Supply services are services that are voted every year annually. And I'll just show a few examples of those next. So here's an example of a Consolidated Fund standing service. By virtue of the Commissioners for Revenue and Customs Act 2005, HMRC is entitled to pay out of the Consolidated Fund for several reasons, including payments into the National Insurance Fund or for tax repayments. So that form of issue out of the Consolidated Fund is permanently authorised. That is a Consolidated Fund standing service. Another example is the Contingencies Fund 1974. The Contingencies Fund can draw upon the Consolidated Fund in order to make emergency advances to government departments. Again, that's permanently authorised by this Act, therefore it's a Consolidated Fund standing service. By virtue of the Banking Act 2009, HM Treasury can draw upon the Consolidated Fund for purposes of intervening in the banking sector in order to ensure, financial stability. Again, permanently authorised by this Act, so a Consolidated Fund standing service. And finally, the National Loans Act 1968 states that the net interest payments paid by the National Loans Fund, in other words, for interest on government debt, can be charged on the Consolidated Fund. So again, permanently authorised standing service. Now, in contrast to that, we also have supply services, and these are a little bit different. They're services that are voted annually, and they result in a Supply and Appropriation Act. Now, usually there are two Supply and Appropriation Acts each year, and they can be considered to include authority for sort of routine expenditure of government, you know, like the allowances of individual departments, health, education, defence, etc. And so they're called supply services. Okay, so what's the significance of all of this? Right. Well, here I've shown the Section 13 and Section 15 from the Exchequer and Audit Departments Act 1866, which actually give the mechanisms by which payments are made. And I guess I've tried to capture the sequence on the left in the diagram. And so step one is the passing of legislation, which might be a Supply and Appropriation Act, or it might be something more specific, a standing service. And then in step two, the Treasury requests money from the Comptroller and Auditor General. Now today, that role is the head of the National Audit Office. And that request is shown in the diagram as step 2A. So at that point, the Comptroller checks that the request for money by Treasury is consistent with the terms under which Parliament authorised the payment. That's step B. And if that is true, then the Comptroller grants a credit to HM Treasury. In step 4, this credit can be cashed at the Bank of England, and that results in an issue of money being made on the order of Treasury to a principal accountant, and I'll describe what that is in just a minute. So the upshot of this sequence is that following parliamentary authority for expenditure, a cash balance is produced in an Exchequer account by drawing on the Consolidated Fund account at the Bank of England. Now, the Consolidated Fund starts every day with a zero balance, as I mentioned earlier. And regardless of that, orders for issues to be made out of the account can nevertheless be made. The account can have a negative balance, and as is described in lots of documentation and also anticipated in the National Loans Act 1968, which is shown on screen there. And in fact, it routinely ends the day with a negative balance. So it follows that issues are made ostensibly as bank advances. The Bank of England issues money, and that is balanced by a debt on the Consolidated Fund. Okay, so I'll now skip too far ahead. I'll now describe Government Banking Service, which is the interface through which expenditure and revenue flows. So the Government Banking Service was established in 2008 and replaced the Office of Her Majesty's Paymaster General, which had operated for about 170 years, I think, previous to that. But like the Office of Paymaster General, the Government Banking Service operates very much like a bank. Departmental allowances are held in a ledger balance system, analogous to commercial bank deposits. And Government Banking Service holds underlying assets which are drawn upon in order to fulfill settlement into the banking system on behalf of departments, much like commercial banks' reserve accounts. I guess it's important to say that Government Banking Service does use commercial banking partners, NatWest for the expenditure accounts, for most of the departmental accounts, and Barclays for the receipt accounts, so HMRC and the DVLA. But settlement for those payments, either going into the Exchequer or out of the Exchequer, is done using accounts held within the Exchequer at the Bank of England. So these are not, well, I would argue they're not true commercial accounts. The commercial partners do not have responsibility for settlement, and therefore they're not commercial bank deposits. Instead, the commercial partners are providing kind of front-end retail banking transmission services. Okay, so just to try and describe the structure of Government Banking Service a little bit more, we can start by showing the Bank of England here and a couple of commercial banks. We can see how the banks are connected to their customers, but they're also connected to the Bank of England via their reserve accounts. And this is how Government Banking Service adds to the picture. Government Banking Service also has deposits, you could call them. And these are shown split across many different holders representing government departments and other entities internal to government. And these deposit accounts within government banking service are supported by 2 settlement accounts. Actually more than 2, but we're showing 2 here as a simplification. And these settlement accounts are at the Bank of England and represent the principal accountants that I described earlier that are referenced in the 1866 Exchequer and Audit Departments Act. So in this case, we've got an account for the Paymaster General and an account for the Commissioners for Revenue and Customs, which represent HMRC. And okay, so hopefully I can now describe how government expenditure works. So the first step shown in the diagram here is the funding process whereby money is drawn from the Consolidated Fund and appears in the Paymaster General account. So that's what happens when those Exchequer credits are cashed in at the bank, and a balance is given to the Paymaster General. And so the next step, which is shown, I don't know if you see the change on the slide just there. The next step is that the Paymaster General can then use those balances to settle payments on behalf of departments into the banking system, much in the same way as any other bank would, via accounts at the Bank of England. Note that this diagram is only representing cash or sterling at the Bank of England. So perhaps this next slide will show the balance sheet impacts a little bit better. So this is hopefully going to try and describe the same process, but in a slightly different way. So if we look at the top left, we've got the starting balances for the Consolidated Fund account, the Government Banking Service Paymaster General account, a government department account, and the Bank of England itself. So notice that the bank has obviously reserve liabilities, but it also holds government securities as the balancing asset, and all the other accounts are 0 at this point. So if we shift to the top right, next we have the Treasury requisition, which usually occurs on about a monthly timescale. This is where the Treasury requests money from Parliament, and the Comptroller and Auditor General approves it and allocates credits, Exchequer credits. So notice that it's Government Banking Service that is holding these credits as an asset. And these represent a claim over the Consolidated Fund, and so they appear as a liability for the Consolidated Fund. And since Government Banking Service holds this asset, it's able to ledger credit deposits to the individual departments according to their allowances that are defined in the Supply and Appropriation Act. So in step 3, bottom left, cash is drawn from the Consolidated Fund, and this is something that would occur on a daily basis, according to anticipated cash flows. And this essentially involves Government Banking Service swapping some of its Exchequer credit assets for a cash asset in their Bank of England account. So we have a cash balance on one Exchequer account, but a cash debt on another. And this increases the overall size of the Bank of England's balance sheet at this stage during the day. Okay, and then the last step, step 4 in the bottom right, the cash balance that's held by Government Banking Service in the Paymaster General's account is used to settle departmental spending into the banking system. Notice that this reduces the public deposit liabilities on the Bank of England's balance sheet, but it increases the reserve liabilities. That's really just a semantic difference, in the sense that balances held by the government at the Bank of England are not described as reserves, they're described as public deposits. And so at this point, the Government Banking Service has shrunken its balance sheet, effectively using up some of the parliamentary credits, while the Bank of England and the banking sector, which isn't shown on here, have an expanded balance sheet. And that's all kind of balanced by a debt on the Consolidated Fund at this stage. Okay, so now we have let's assume that that's the entirety of the day's activities, which is obviously quite unrealistic, but let's just assume that for argument's sake. The Exchequer has an end of day process that seeks to rationalise all of the cash balances held. Now, this doesn't affect, for example, the Exchequer credits held by Government Banking Service or the deposits held by government departments in Government Banking Service. They are simply internal to the Exchequer. But rather, the consolidation which happens at the end of each day refers only to cash balances, i.e. the balances held at the Bank of England. So here's a kind of a diagrammatic representation of what happens at the end of each day. Tax receipts are shifted into the Consolidated Fund, and the balance on the Consolidated Fund is then shifted into the National Loans Fund. But the other thing that's shown on that diagram is that any remaining balances, cash balances held in Government Banking Service, are transferred directly to the National Loans Fund as overnight lending. Again, just try and show that in a slightly different form. We can see that we have accounts held at the Bank of England, the Paymaster General account and the HMRC account, both part of Government Banking Service, as well as the Consolidated Fund and the National Loans Fund. And all of those start every day with a zero balance. So the next step, number 2, is a drawdown from the Consolidated Fund, and that results in equal and opposite balances on the Consolidated Fund and in the Paymaster General account. The Consolidated Fund being in debt, the Paymaster General account being in credit. And then in step 3, the Paymaster General settles payments into the banking system, and so its balance is somewhat depleted. Also during the day, HMRC may receive transfers into its settlement account in the Exchequer. That's step number 4. And then at the end of each day, in step number 5, those tax receipts are transferred to the Consolidated Fund, and they will have the effect of reducing that net debt or that original debt on the Consolidated Fund. So then in step 6, the Paymaster General's remaining balances are shifted to the National Loans Fund as an overnight loan. And then finally, the Consolidated Fund is also shifted into the National Loans Fund. And what that results in is what is known as the net Exchequer position. So it's the net balance of all of the cash accounts, the cash accounts at the Bank of England held by the Exchequer. And in this case, it's a net deficit. Now, that net deficit also, by accounting identity, equals the net surplus that would be featured in the banking system itself. Okay, so now we can talk about something called the Ways and Means account. So in the scenario that I've described so far, the Exchequer has ended the day with a debt to the Bank of England, which is held on the National Loans Fund, having spent into the banking system. Now, there is a formal relationship between the bank and the National Loans Fund for recording such a debt, and it's called the Ways and Means account. Now, it's often construed as the government's overdraft facility, but it's really just another form of government security that can sit on the Bank of England's balance sheet, backing the bank's money issuance. So in the example that I've described so far, we could end it there by saying that the debt on the National Loans Fund simply becomes formalised on the Ways and Means account. Now, that's not typically what happens, because there is additionally, in most cases, a policy response, which I will describe in a minute. But I think the story so far is important because it explains how and why any spending authorised by Parliament will happen without any constraint. If no additional policy response is undertaken, then that spending will simply be expressed as an increase in the Ways and Means account held at the bank by the National Loans Fund. Okay, but there is typically a response that's undertaken, and that is what we describe as cash management. So cash management represents the trading of government securities by the Debt Management Office. And I think it's important to understand that this is a policy response. Now, everything I've described so far with respect to spending has had its crucial aspects rooted in legislation. Cash management is motivated by Her Majesty's Treasury's policy, basically, and so from that perspective, it's a lot more discretionary. Now, the process of cash management is usually construed as a borrowing exercise motivated by the need to provision government, and we question that framing completely. As we've seen, government doesn't need to provision itself in order to spend, so that's clearly not the motivation, and instead, the debt management officer's cash management remit is simply to offset the government's financial flows. Now, if we look back at how cash management was undertaken prior to the Debt Management Office being established in 1998, we see that it was done with an eye on the Bank of England's monetary policy objectives. That is, with a view to restore some sort of perceived balance to the banking system in lieu of the various daily flows across the banking sector's balance sheets, including but not limited to those flows produced by the government. So we think it's better to see cash management as kind of a hygiene process. It's the government tidying up after itself. The Treasury's policy for the Debt Management Office today is for the Debt Management Office to completely offset any daily exchequer deficit or surplus by trading in government securities by the end of each day. And what this means is that the ways and means account that I just described is to be avoided. And that essentially means that any debt that the Exchequer has to the Bank of England is converted to tradable debt that is held outside of the Bank of England within the day. I should say that ultimately depends on the Bank of England's own operations, which may, of course, as we see today, buy back that debt. Current practice is also for the debt management account to hold a positive balance, which is not expected to vary from day to day. So in order to just describe that a little bit further, we can add to this diagram the debt management account now at the Bank of England, and we can see how flows occur between the banking sector and the debt management account according to market activities. And then ultimately, the debt management account's job is to transfer money either to or from the National Loans Fund in order to offset that net exchequer position. Okay, so here we have two cash management scenarios. Along the top is the case of a daily exchequer deficit, and on the bottom, a daily exchequer surplus. So along the top, in the first step, as I described before, we've got the Consolidated Fund and the National Loans Fund starting the day with a nil balance, whereas the debt management account always aims to have a particular fixed positive balance. So during the day, activities on the Consolidated Fund and the National Loans Fund can cause variations in their balances, but at the end of the day, the Consolidated Fund is swept into the National Loans Fund. And this represents that net exchequer position that the Debt Management Office has the task of offsetting. So in this case, on the top, it has in number 3, it has a deficit on the National Loans Fund to try to offset. So it achieves that by selling securities and increasing its own balance to the extent that it can make the required transfer to the National Loans Fund. That's in step 4, and then in step 1, once the money has been transferred to the National Loans Fund, we see at the end in step 5, the National Loans Fund is at 0 and the debt management account is back to its target level. On the bottom, we've got the case of an exchequer surplus. This is pretty similar, except in this case, the Debt Management Office needs to buy government securities back from the private sector in order to try and dispose of the cash surplus that was sitting on the National Loans Fund at the end of the day. Okay, so what's the significance of this? Well, I guess it's tempting to view the Debt Management Office as funding the Exchequer's spending, and that's an understandable viewpoint when you're taking a sort of a long distance viewpoint, in the sense that the debt sales that are made by the Debt Management Office each day are intended to match the deficit for that day. But the structure of the Exchequer, in the way that we've described it, we think produces very different implications for understanding the constraints on the government in comparison to the standard viewpoint that you often hear, whereby the government spending has to be pre-funded. And the differences are, I mean, firstly, the Exchequer's spending does, or at least certainly can, happen before the Debt Management Office does anything. And it happens without any obstacle. The cash management activities of the Debt Management Office has no impact on whether the government spending happens. So nothing stands in the way of the Exchequer spending into the banking system. It's not dependent on the Debt Management Office's activities at all. Secondly, as explained by the Bank of England about half a century ago and described in the quote in the bottom right there, the banking sector itself will always purchase any securities which need to be sold according to policy requirements by the end of each day. And that's because they are, by definition, holding excess funds by virtue of the Exchequer's spending that day. And they would reflexively want to seek to put those excess funds to their best advantage, which would usually be to switch them from reserves to government securities. So in that sense, the Debt Management Office isn't faced with, a market holding scarce funds and seeking to bid up the prices that are charged to the government, as is commonly depicted. But instead, the requirement for the Debt Management Office to sell securities is matched identically by the banking sector's excess money balances, which were produced by the Exchequer spending that day. And so in that sense, there are no bond vigilantes as are commonly invoked. And that also explains why the Ways and Means account is after all, scarcely actually required. Okay, so I'll finish up by just making a few remarks about tax and national insurance. It's comparatively straightforward compared to the expenditure system that I just described earlier. Now, tax is collected, as I think I mentioned earlier, by the government banking service commercial partner, Barclays. And so on the screen, we can see here a tax payment being settled from a taxpayer's bank, Lloyds in this case, into an account at Barclays. The next step is that a transfer is made across the Bank of England, the accounts at the Bank of England, into HMRC's account within government banking service. And finally, as I think I mentioned earlier, that those tax receipts are shifted to the Consolidated Fund by the end of the day. And as I showed earlier, the tax receipts that are transferred to the Consolidated Fund may serve to offset a spending deficit that was already on the Consolidated Fund, or in some cases will produce a surplus on the Consolidated Fund. Now, national insurance is actually slightly different. There's a slight nuance with national insurance. National insurance does not have to be surrendered to the Consolidated Fund by law, and it has its own separate statutory authority. Now, national insurance has responsibility for paying out certain social security benefits, such as the state pension, and many folk consider the National Insurance Fund to represent kind of like a pre-funded hypothecated tax. That is that there's a pot of money to which they have contributed to, and from which their pension and other benefits are paid. Now, it is true that the National Insurance Fund has a large amount of wealth, and according to the accounts that were produced last March, that is £39 billion. But actually, that does not represent anything other than an internal record within the Exchequer. The reason being that, as you can see on the screen there, national insurance contributions, when they arrive in the Exchequer, they are simply sent to the debt management account. Now, what does the debt management account do? It does the cash management, and it always seeks to have a constant balance each day. It's not retaining surplus receipts. To the extent that there are surplus receipts, they are recycled back into the banking sector. So the contributions that are received by the Exchequer for national insurance are not retained as cash, but they're submitted to the debt management account where they are recycled, but recorded as a deposit in the debt management account. So the 39 billion wealth of the National Insurance Fund is a deposit inside the Exchequer. Now, so it's not money as we would see it. It's not cash at the Bank of England. It's not a commercial bank deposit. But in some senses, it's better than that. It's a claim on the Consolidated Fund, which, as hopefully I've demonstrated earlier, is as good as cash by virtue of the Exchequer and Audit Departments Act 1866. So there's a couple of things that we would conclude regarding tax and national insurance. One is that taxes don't really fund spending in the way that is commonly invoked, but they do help to mitigate the potential effects of spending on the banking sector, as in they're another function that causes an offset of the spending within the banking sector, just like the cash management activities. But also, since tax has to be submitted legally to the Consolidated Fund, and since the Consolidated Fund is an account at the Bank of England, this means the taxes are ultimately settled in Bank of England money. They're not settled using commercial bank deposits at all. Instead, commercial banks act as the agents of taxpayers in settling tax payments on their behalf using central bank money. And I guess the significance of this is that simply the need to be able to settle taxpayers' tax payments into the Consolidated Fund means that there will be a demand for central bank money. And therefore, there needs to be a sufficient supply of central bank money or government securities, which are the medium of exchange typically used for obtaining central bank money, in order for tax payments to be able to be made. And the National Insurance Fund effectively functions exactly like everything else in the Exchequer, via issues being made from the Consolidated Fund and surplus receipts being recycled back into the banking sector. There are some additional accounting nuances that are simply internal to the Exchequer that help to account for national insurance, but that's about it. There isn't a big pile of cash, that represents the National Insurance Fund sitting anywhere. And so I think that's about as much as I thought I would have time to say. And it looks like I'm about on time, if maybe slightly over. But I'd say, I think in general, our conclusions would be that spending is guaranteed by parliamentary authority, and it's not constrained by balances or other banking arrangements, contrary to what is often invoked, at least in public discourse, maybe not by slightly better informed folk in the economics community. But equally, the popular conceptualization of government borrowing is also pretty questionable. The government's not beholden to market sentiment, at least not most of the time. And government securities, we would argue, function